In our little example here, we're able to calculate GDP, gross domestic product, the value of production in the simple economy with the two goods. So we had beer and we had pizza. We calculated GDP for each of these two economies. So as we'll see, another way to measure production would be to look directly at expenditures. Now, one thing I want to point out, expenditures is not the same as consumer sales. So consumer sales are part of total expenditures, but other parts of the economy buy things too. The government buys stuff, right? So when the government buys a computer, that is an expenditure on a good or service. Or the government buys a pizza, in our example, that is going to be an expenditure. Firms buy things, right? Companies buy goods and services, and that's all going to count as expenditures. Foreigners buy things. So just looking at consumer sales is not the same thing as expenditures. Okay, so we'll define expenditures a little bit in a little bit more detail here in one of the next videos. So one thing that we have learned, though, is that anything produced has to be bought in some sense. Now, you might say, well, I don't know, right? I mean, stuff sits on shelves all the time. So some of you may have worked in retail. So either, let's say, at a grocery store or some type of retail store. And you probably have this period of time that happens every month or so, or every quarter at least, where you have to take inventory. So you have to literally go through the entire store and take account of everything that's there. And at the end of the year, some of the stuff produced doesn't get sold. So what happens to that? Well, that's what we call inventory. And it's technically counted as part of what we call investment. And we'll define that more specifically here in another video. But what we're assuming is that the firm is effectively buying these goods, right? So the firm produced something and it's going to sort of buy them from itself and count it as inventory. And if I understand that part of inventory, then my expenditures definitely have to equal my total production, right? Everything produced has to go somewhere. It's either sold to someone or it's going to be bought by myself as part of inventory. So one thing we have is that my production should equal my total expenditures. Okay. Now what about income? Turns out that we could also add up all of the income in our economy and arrive at the same value of GDP as we would if we counted production or expenditures. So income, in the most general sense, I would add up as either wages or profits, right? So think of a firm that makes something. Where does the revenue that they produce go? In a very simple way, it's either going to go to wages to pay the workers who made the stuff. Whatever's left over is going to be profits for the owners of the firm. So in a very simple setting, I'm going to call income wages plus profits. But if I break this up finer, we're going to kind of arrive at the same conclusion. So notice, let's say that the beer producer pays wages of $100 to its workers. The pizza producer pays $200 to its workers. Let's calculate profits and add up wages and profits in our economy. And let's see what we get. How does it compare to GDP? Okay, so I'm just going to go to another document here. So let's look at Economy 1. And I'm going to look at the beer producer. The beer producer made in Economy 1, I think it was $50 beers. And those beers sold for $5. So the beer producer made a total of $250 in revenue. They paid the workers $100. So by our definition of profits here, it's going to be my $250 of revenue minus my cost of 100 is profits of $150 from the beer producer. What about the pizza producer? What did they make? I believe in Economy 1, they made 100 pizzas. Those sell for $10 each. Sorry. Which means they have $1,000 in revenue. So their profits, or their revenue, 1,000, minus their costs, which were 200, gets me to $800 in total profits. Now, let's add up total income. Wages plus profits. Well, our wages were 100 from the beer producer plus 200 from the pizza producer. Profits were 150 from the beer producer and 800 from the pizza producer. So we have $300 in wages plus $950 in profits, which adds up to exactly $1,250, which was also our GDP, which is thus also our total income, right? So I know it's a very simplified version, and if you look carefully at this, you realize that when I calculate wages and profits, I'm just sort of adding and subtracting the same number, right? So that in the end, what's going to get added up in total is the total revenue or the total value of production, which is GDP. So that gives us a very simple way to kind of break down our GDP numbers. And we see that this all has to add up at the end of the day. So if I look at what we call the circular flow, it tells me that all production has to go somewhere, right? So as I break up the economy into different groups between producers and consumers, the inputs to production, labor, etc., everything that we make has to go in one of these places, right? So I can capture the output by measuring the production directly. I can capture it by measuring our expenditures, or I can capture it using our income. And so this might seem like a minor point, but it's actually really important to realize that these three things are equal in our circular flow diagram. Everything that's produced goes somewhere. All right, so that is sort of the end of our introduction to GDP. We'll move on to a few more of the details in our next video.